JPMorgan Chase, the second largest U.S. bank by assets, but the first to report earnings, has beaten analyst expectations with earnings of $1.12 a share relative to $1. That's what Wall Street was looking for. Jason Tyler of Ariel Investments is with us now from Chicago, a former JPMorgan employee. He oversees financial investments for Ariel. And Jason, I know you're a fan of JPMorgan, so let's talk about these earnings in the context of your interest in the stock. Are you impressed enough to see it rise today?
Yeah, this is a good beat. This is very high quality, and the one negative that people always point to on Jamie is his ability to increase revenue in a company, to actually grow a financial institution. And the good revenue growth we're seeing here is indicative of the fact that the franchise is doing extremely well.
Now, we just flashed a picture of the stock price in pre-market trading. It's flat to down slightly. Are we back where we were at the end of the third quarter, raising questions about the earnings quality at JPMorgan? Because there is a release, and this we have to explain this to everybody. A release of $1.9 billion indicates that JPMorgan is flowing down to the bottom line almost $2 billion of money that it had set aside in the past for bad loans. Now that serves to pad earnings.
Right. And so effectively the bank is saying that they've reserved too much historically, and now they're able to release some of that and take that credit into earnings for this quarter. But if you look at the stock over the long run, Erik, over the past year, it's almost exactly flat. So I think what we're seeing here is that a lot of investors are looking for other financial institutions that had more hair on them, that had more negative press in them, seeing that as the economy gets a little bit stronger, those other stocks could become stronger. And JPMorgan had done so well in the crisis, so people are looking for those weaker names to rebound more quickly.
Jason, I want to ask what your take is. I mean, last quarter we saw retail banking 20% of the company's earnings, or rather revenue. Now it's 15%. Is there anything to read into that?
Well, Deirdre, it's a good question. The way I think about JPMorgan is that of about the $45 in stock price, I think about half of that's the investment bank, about $13 is card, and I think $10, $11, $12 is in the retail bank. And one of the headlines I saw just in getting through the release in the few minutes before I came on was that they're investing in the retail bank. And, you know, Charlie Scharf has run that business for a long time. JPMorgan's gone from, frankly, a weak retail bank franchise nationally to what I think is one of the top 2 or 3 in the country.
But Jason, the top 2 or 3 standing isn't translating into huge earnings on the retail side. Let's talk, though, for a moment about the other half of the retail equation. Credit cards, a huge driver for JPMorgan this quarter, accounting for almost 30% of the bottom line. Do you think that's sustainable into 2011?
Well, I do think that it could do well, but you think about the fact that a lot of the reserve release is probably going to have come from that unit. That's not sustainable. And so they're going to have to try and figure out how to do better to grow that. But by the same token, we're still looking at about 700 or 750 basis points in charge-offs. That's still an inflated level, Erik, and that's going to come down. I think we can see 4.5%, 5% in the long run. And so if you think about which businesses are still weak and are going to be a lot better in the long run, card is at the top of the list.
Jason, we want to put you on the spot because you've been good enough to join us. We haven't heard anything about a dividend increase. We haven't heard anything about a buyback of shares just yet. With these numbers, what are the chances that we'll see 1 or 2 of those headlines?
Well, I think once the regulators allow the bank to increase the dividend rate, it'll happen. Right now, sitting at $0.05 a quarter, that's effectively nothing. And the reality is, investors like to see it, but I hate it. And I don't think Jamie and the rest of the management team likes it much either. When you're looking at a stock price that's trading at less than 10 times forward earnings, and you could buy back shares at that price, you'd much rather allocate capital to buying back stock than just dividending it out.
With Jason Tyler of Ariel Investments, we're talking about JPMorgan's fourth quarter earnings beating analyst expectations handily with EPS of $1.12 a share. Jason, just before the break, Deirdre was asking you questions about the dividend. And I know it's difficult to anticipate exactly what Jamie Dimon is going to do with the dividend, but I want to know what investors are going to do because you have true insight into that. Is this dead money? Is this stock dead money until JPMorgan starts to return capital to shareholders in the form of a dividend or a significant stock buyback?
Well, the market's always very forward-looking, and I think that Jamie's been pretty clear that he's going to try and get the dividend up over time. I think you can look for 75 cents, maybe a little bit more than that on an annualized basis. And at that point, people will get more interested. The reality is that investors more than ever want to see dividends coming out of their investments. They want to see good cash flow. But you're on to a really important factor, which is that for some reason the market's had this stock is pretty dead for the last year, which frankly has surprised me a lot because I feel more confident than ever that earnings are going to be higher over the next couple of years, yet the stock isn't reflecting that.
Well, you were rewarded over the past 6 weeks. Stock's up some 20% over that period. We would be remiss in talking about a Wall Street bank if we were not to cover the issue of compensation. Jamie Dimon has a reputation for being able to manage comp and keep it under control better than perhaps some of his peers. One of the things that really surprised me about these numbers is the fact that we're talking about an improvement in conditions, and yet compensation per employee is down by some $10,000, $369,000 on average in the investment bank versus almost $79,000 last year. What do you make of that?
For last year. Jamie does a really good job of communicating to employees the need to get earnings up before compensation goes up. And I think managing that type of expectation internally is incredibly important. And the whole management team there does an excellent job of it. And I think he sometimes, gets these goals in his head of trying to get to a certain level. And I think getting to $4 a share in earnings, trying to get to a better return on tangible equity. They're getting into a pretty good range right now. I think they're probably at about 16% for this quarter. So these goals are important hurdles for the company to reach before compensation goes up. And frankly, you look around Wall Street and how many of the big investment banks are hiring tens of thousands of employees this year. So the employees don't have a ton of options right now.
So maybe the employees aren't going to be so happy, Jason, if they're not going to get a great bonus and they don't have any other options or anywhere else to look for a job. But I want to talk a little bit about, you're talking about Jamie Dimon sort of managing expectations. One thing that's shifted is that Heidi Miller has been named to head up the international activity. Does this change the direction that JPMorgan Chase wants to go in? How is it going to manage expectations as far as international expansion goes?
Yeah, I think it's an important topic, Deirdre, and I'm a huge fan of Heidi. I think she's a tremendous leader. She's got great experience internationally. I think people don't realize that. Earlier in her career, she spent a lot of time. She spent some time in Latin America, so she's got a great vision for how to grow a global franchise. And I think that's one of the growth areas that we're going to see coming out of JPMorgan over the next couple of years. And it frankly has been completely overlooked, I think, by the marketplace.
Jason, before we go, a minute perhaps to break, let's talk about the investment bank. Investment banking fees, mergers and acquisitions, debt and equity underwriting, a really strong quarter for JPMorgan at $1.8 billion. But what do you make of the drop in fixed income trading revenue? Less than $3 billion for the first time in 2010, 2.875 to be precise. Is something wrong with JPMorgan's franchise, or do you think we'll see similar numbers from the likes of Goldman and Citi?
Yeah, one of the things I do intra-quarter in between earnings releases is really try and track anecdotally how the different investment banks are doing in different categories. And I didn't get any sign that JPMorgan is losing ground in fixed income. And so I think this might be just a situation where volume in the fixed income market is starting to reduce in line with the reductions that we've seen in the equity markets over the last 6 months or so. But I think the big thing that JPMorgan's gotten is big market share rises, so I think that'll continue even in fixed income.
Jason, good of you to join us here on the Inside Track.